The Federal Reserve has published an official statement that they are about to pump $500 billion of liquidity into the financial system in a month. This will be the biggest ever pump in history. The balance sheet will hit an all-time record high in January as a result. Bigger than before they started to wind down the balance sheet, but it's not QE, so don't worry. All of this is to prevent any potential issues at year-end, which could be much more devastating than on September 17th. The only question is, what is the Fed planning on doing to actually resolve the underlying issues? You came here for the truth, so let me unveil that for you. I wanted to start with a little bit of humor because you and I both know that the Federal Reserve will not tackle any of the underlying problems because, of course, they are the root cause. Now, we had the press conference, it was a couple days ago. Jerome Powell, he made the statement, then they take the question and answer. I did a video about this. One of the individuals that asked the question brought up the year-end problems, of course, with the repo issues, and was asking to expand on that. Jerome Powell said everything is totally fine. We're going ahead as planned. Nothing to worry about. Nothing to see here. That's what the media reported. Stocks loved it, of course. Then 2 days later, the Federal Reserve releases this statement suggesting everything is not okay because they're about to engage in the biggest pump in history. I'm going to give you everything you need to know today. I'm going to show you the statement. We're going to look at what's happening with the balance sheet. I'm going to give you all of that. So let's begin with this. The trade deal, obviously so important. US and China aim to sign a phase 1 deal in January. So it was a done deal back in October. It was a done deal in December. And now it's going to be a done deal in January. That might be the case, but there are some details, of course, that need to be ironed out. This happens to be from an actual legitimate source this time. This is Robert Lighthizer. That's about as high as it can get. And what they claim is that China is going to have to buy $40 billion worth of agriculture, and then they later will buy $50 billion of agriculture. They still have to work out all of the details related to IP and other issues that they've been having. Those right there are the difficult ones. The agriculture, very easy, except when you look at the actual producers of those crops. You know, the US farmers would love to be able to plant crops and sell them to whoever is going to buy. They are able to get the bailout money when those come around, that's for sure. There's another issue though. If you're a US farmer, are you going to go and start to plant excessive amounts of, let's say, soybeans if you are unsure if China is going to be able to come and actually buy those from you? That's the big question mark here for the farmers, as well as the fact that China had gone to Brazil and other places starting to look for new partners to purchase agriculture from. I'm not aware if they actually signed into any agreements and all the details of that, but that would be a problem if they've already signed into something and of course would not be able to fulfill their promises they made according to this deal, which apparently is never going to be made public. Here we have the balance sheet of the Federal Reserve. It is important to note right now that we are almost, just another week left, almost here at $4.1 trillion. $4.1 trillion, not too far off from the peak at which it lasted for quite some time, 4.5 trillion approximately, give or take. And this right here just shows you that ever since September, they've been pumping their balance sheet up. What they call actually, it's not just some sort of monetary injection or anything. This is literally the word that they used, organic. It's an organic growth of the balance sheet. And as of January, according to what they're about to do, the statement that they issued, they will actually exceed that $4.5 trillion in January. And of course, will go far, far beyond that. So I wanted to get into that in a moment because I wanted you to see this first. Now, you'll look out there in the mainstream media and the analysts will talk about the Fed's balance sheet perhaps. Maybe they might mention it here and there. They'll talk about the stock market. They may even mention the computer algorithms. They'll talk about anything on the surface level. But do they ever compare these two together? What we're looking at in this chart here is the weekly change in the S&P 500. And in the bottom, we see the weekly change in the Fed's balance sheet. Now, I don't know about you, but even if you didn't have 20/20 vision, I'm sure you can see the charts that happen to mirror each other very, very well. Take a look at this. we see that when the Fed's balance sheet expands, it is also expanding the S&P 500. And when the balance sheet contracts, we see the same thing for the S&P. Now that right there just shows you how directly correlated they have been. This chart goes back to the beginning of October, but of course I have shown you this in so many other charts. When we compare the balance sheets of the world essentially to the S&P 500, there's no denying it, okay? Because this money, even if it's not actually buying the stock itself, printing that money sends the world in a tumble, flooding like there's no tomorrow, and it has to end up somewhere. Risk is on, obviously. So the safest bet for institutions happens to be the US markets. And of course, we have stock buybacks and all that other stuff that has been adding up. Now I wanted you to read the statement here with me for a moment. December 12th, 2019. They posted this and it was quiet, of course. They didn't want to mention the fact that they're about to engage in the biggest operation they have ever done in history. And yet at that press conference, they didn't mention a thing about it. But of course we know why. Statement regarding repurchase operations. By the way, this is directly from the New York Fed's website. I don't take any other website their word for it. I actually look at the legitimate source. I'll give you the details here really quickly. The open market trading desk at the Federal Reserve Bank of New York has released a schedule of repurchase agreement repo operations for the monthly period from December 13, 2019 through to January 14, 2020. So basically a 1 month period. They will engage in these operations. Here you can see they're referring to the 2-week term repo operations twice per week, 4 of which will span year end, and they will offer another longer maturity term repo operation that spans year end. The amount offered in this operation will be at least $50 billion. Oh, but it gets better. Check this out, next paragraph. Overnight repo operations will continue to be held each day. The offering will increase to at least $150 billion, as well as these operations at $75 billion. The desk intends to adjust the timing and amounts of repo operations as needed to mitigate the risk of monetary market pressures that could adversely affect policy implementation consistent with the directive of the FOMC. Now, we get this information all the time coming through. New statements are posted, of course, but this right here is historic. I want you to put an asterisk on this one because it is huge. And I do believe that we'll see bigger ones in the future, but at least at this moment here, going into 2020, this is certainly the biggest we have ever seen. Now, you didn't think I would just leave you with that statement without showing you the actual details. Of course, you can see it for yourself here at the New York Fed website. Schedule of overnight and term repurchase agreement operations. All of that is listed right here. You can see the dates at which they will be proceeding with these operations, whether it's 120 billion, 150 billion, and so on. All of that is listed here. And then you add up all of these as well, and you get to a number that is very, very close to $500 billion. Now, while you look at the number of 500 billion, it is big, but compared to the total market size, sure, 500 billion, not that big of a deal. But when you see the fact that this is in a 30-day period, number one, the fact that it is the most ever that we have seen in this period, and the fact that the Fed is now required to be present in the system at a level which they never have before, or else the market will completely collapse. This tells you how weak this really is. Something is truly, truly wrong right now, and it is evident right here in the Federal Reserve's actions. I have been talking about this so often that I have actually lost a lot of subscribers. My viewership keeps going down, but I'm not going to stop talking about it. It is extremely important, and I know that my faithful subscribers will hang on here because this information is critical to understanding what is underlying all of this. This report out of the biz had some interesting things to say that I just wanted to mention, of course, because it's correlated here. The reasons for the dislocations are still not entirely clear. Alongside some temporary factors, structural ones appear to have been at work. A key one has seemingly been the combination of two forces. On one side, high demand for secured repo funding from non-bank financial institutions such as hedge funds heavily engaged in leveraging up relative value trades, and on the other, the big four banks' unwillingness to supply the funding as their liquidity buffers, notably in the form of excess reserves within the Fed, were running low. They talk about the big four in here. They talk about structurally what's going on inside of the financial system. This biz report, if you haven't seen it before, definitely check it out. This gets into the details that are so important, and yet when it was briefly brought up to Jerome Powell in that press conference, he completely ignored that part of the question, and it's pretty obvious why. Now, this article and the next one is interesting because we saw coming into this repo mess that JP Morgan was obviously really at the center of a lot of this. And Jamie Dimon came out and actually said a few words about it. Essentially, the rules are too tight. You need to make it easier on us. You need to give us more incentives to keep that cash with you, or else you're always going to have problems. Take a look at this. US regulators signal openness to rethink practices that caused the repo market woes. In a potential win for the banking industry, two top US regulators on Wednesday signaled that they may be open to changing supervisory practices that may have contributed towards disruption in the overnight lending markets. So one of the Fed vice chairs, Randall Quarles, said that the central bank is reviewing its supervisory practices in the wake of a September liquidity crunch in the repo market. I want to tell you what's happening right now. They're trying to relax the rules so that these corporations can use more leverage, that they can take more risk. And of course, you know what happens every time they're allowed to do something like this. We have identified some of the areas where our existing supervision of the regulatory framework may have created some incentives that were contributors. They were probably not the decisive contributors, but they were contributors, and I think we need to examine them. Of course, nothing good, nothing beneficial, nothing will actually change fundamentally because we're in a risk-on environment. We always do this every single time. Pedal to the metal, push it to the maximum, let's see how far we can take it, and then, oh no, there's a major crisis and everyone's yelling and screaming. Instead of things being more calm, cool, and collected, they are highly exaggerated, and this is a terrible thing. And then what do you have? Examples like this. This type of behavior and this individual here needs to be reprimanded at some point in the future. Check this out. Quote, back up the truck and buy. That was the advice from Chris Rupke, chief financial economist at MUFG Union Bank. All over the world, markets are falling in love. Buy it all, reads the headline of the note that he wrote. However, if you look at the bottom of the page, there is some smoke and mirrors here, but it looks like this is the time for investors around the world to throw months of caution to the winds and take risk off the table, and they are buying stocks and selling bonds with abandon. And then talks about how wonderful things are, the central banks are easing, and so on. I'm not saying either way is the right thing to do, but this is the type of behavior that we've been seeing for 10 straight years. Nobody is cautious anymore, and we've exaggerated all of the previous bubbles that are only made worse by this type of rhetoric. Take a look at this really quickly. This is a really good chart from howmuch.net, which goods are most traded between the US and China, and it gives you a breakdown of that here in this chart. Clearly, the United States is importing a hell of a lot more than it exports to China, that's for sure. So it just gives you a breakdown. If you're interested, check it out. That's all for this video. If you found it informative, hit the thumbs up button. When you give me a like, you're supporting this channel, so I do appreciate that very much. If you want to learn about making money, passive income, business, and everything in between, I created an e-course just for my subscribers, and I made it free. It is about selling on Amazon. It teaches you the strategies that are largely not found in other courses that you got to pay a lot of money for. I talk about building a brand and making it sustainable. That's available at the AmazonGPS.com. If you want to learn about the financial system, I've got everything in these two books right here. The foundation, the history, the asset classes, all the details that you need to know. Check it out at the link in the description. If you want the audiobook, themoneygps.com. Hold on, hang on a second. Don't go anywhere. Don't click off. You need to watch this video. Click on it and I will see you there.